Welcome to the Real Money Pathway, where I share my journey from financial collapse to lasting wealth. I'm David Kim, and I'll guide you through practical strategies that transform my finances and can transform yours too. Let's build your pathway to financial freedom.
The content of this podcast is provided for general information purposes only and do not constitute financial advice. Listeners should not act upon the content or information here without first seeking appropriate advice from a financial professional.
Welcome back to Real Money Pathway. I'm David Kim, and in our last episode, we talked about developing the protection mindset, that crucial shift from just making money to actually protecting what you build. Today, we're diving into one of the most important protection layers, insurance. And I'm going to be completely honest with you. Insurance was the protection layer that I screwed up the most during my rebuilding years. Picture this, 6 months after my bankruptcy, I'm driving to a client meeting when someone runs a red light and hits the back of my car. I was fine, but the car was totaled. And that's when I discovered I had made a classic mistake. I was carrying minimum liability coverage required by law, but I had dropped that comprehensive and collision to save money. So there I am, car totaled, no rental coverage, and basically no way to get to client meetings to earn the income that I needed. All to save under $40 a month on insurance premiums. That's when I learned a hard lesson. When you're rebuilding financially, insurance isn't an expense you cut. It's protection you can't afford not to have, but you also can't afford to buy everything, so you need to be strategic about it. Today, I'm going to share exactly how to think about insurance during financial recovery and rebuilding, what to prioritize when money is tight, and the mistakes to avoid that could derail your recovery. Let's talk about essential versus optional coverage during your recovery. When you're rebuilding after a financial setback, every single dollar matters. So the question becomes, which insurance coverage is truly essential and which can you temporarily live without? After that car accident wake-up call, I sat down and created a insurance triage system of sorts, kind of like a hospital emergency room where you treat the most critical issues first. This came out to 3 tiers. Tier 1 is the absolutely critical, never skip these. Health insurance, of course, tops the list, period. I don't care how tight money gets, going without health insurance, especially during financial recovery, is like removing your seatbelt to save weight while driving faster. One medical emergency can wipe out your years of financial progress. When I was consulting and shopping for individual health insurance on the marketplace or the ACA marketplace, I focused on a catastrophic protection rather than low deductibles. I chose a high deductible plan with a $6,000 deductible, but excellent coverage for major events. Yes, I'd pay more out of pocket for routine care, but I was protected against those 6-figure medical bills that would destroy my recovery. Auto liability insurance is non-negotiable if you drive, but here's the key. Don't just buy the state minimums. I learned this the hard way. Most state minimums are laughably low. You need enough liability coverage to protect any assets you're building. I carry a $100,000, $300,000 liability minimum. It only costs about $15 to $20 more per month than the state minimums. Tier 2 represents the very important ones, the ones that are prioritized next. Disability insurance was a huge blind spot. I was so focused on protecting my stuff that I forgot to protect my ability to earn income. Statistically, you're more likely to become disabled than die before age 65. If you have employer-provided disability insurance, that's great, but understand what that covers. Most employers only cover 60% of your income and have a very strict definition of disability. I supplemented my employer coverage with additional short-term disability insurance. And then property insurance, whether you're homeowners or renters, protects your living situation. But here's the strategy. I increased my deductible to $2,500 and kept that amount in a separate savings account specifically for the insurance deductible. That lowered my premium significantly while ensuring I could actually afford to use the coverage. And finally, tier 3 are the ones that are important but can wait. This is where life insurance falls, unless you have dependents. If you're single with no kids, life insurance can probably wait until you've built other protection layers. If you do have dependents, term life insurance is very affordable and provides what you need during rebuilding. Comprehensive and collision auto coverage. This is where I made my mistake. If your car is worth less than $5,000, you can replace it from some parts of your savings, or you can skip these temporarily. But if losing your car would jeopardize your ability to earn income, this becomes tier one. The key insight I learned is that insurance priority isn't about the likelihood of things happening, it's the financial impact if it happens and when it happens. A fender bender might be more likely than a house fire, but you can probably handle a fender bender out of pocket, but you probably can't handle rebuilding your whole house. My approach was simple: insure against catastrophes first, inconveniences second. This meant carrying higher deductibles to keep premiums affordable while maintaining protection against truly devastating loss. Next is smart shopping strategy for your insurance. Here's something insurance companies don't want you to know. Your credit score impacts your insurance premiums, sometimes dramatically. During my rebuilding phase, especially after bankruptcy, my damaged credit was costing me hundreds of dollars annually in insurance premiums. But I discovered other strategies to minimize this impact and actually improve my insurance situation while I was saving money. First, you can bundle insurance packages strategically. Most people know about bundling, but they do it wrong. Don't just bundle with your current company. Shop the bundle as a package. When I was rebuilding, I discovered that switching everything insurance wise to a new company and bundling it saved me $1,200 annually compared to just keeping my existing policies separate. The key is timing. Shop for insurance about 30 days before your current policies renew. This gives you time to compare properly without being rushed into a decision. Next, leverage affinity programs. This was a game changer. Professional associations, alumni, even AAA membership can provide access to group insurance rates. Military veterans have additional options. USAA, if you're eligible, offers excellent rates. Even if you're not eligible for USA, many companies offer military discounts, and that can be pretty significant. The next strategy is to increase deductibles systematically. Instead of carrying low deductibles that I couldn't afford, I did something counterintuitive. I increased all of my deductibles and saved the money separately. Increasing my auto deductible from 500 to 1500 saved 35 a month. Increasing my homeowner's deductible from 1000 to $2,500 saved me another $28 a month. That's a total of $63 in savings per month for over $700 a year. And I was able to put that $63 monthly savings into that insurance deductible fund. And so within 2 years, I had enough saved to cover any deductible. The next strategy is to understand the renewal game. It is a game. For insurance companies, they always give new customers better rates than loyal existing customers. Every 2 years, or even sooner, I shop my insurance quotes, even if I'm happy with my current coverage. And most of the time, I switch. Sometimes I use competing quotes to negotiate better rates, though, with my current company. And the last strategy is to work with independent agents. During rebuilding, I found independent agents more helpful than agents that are tied to a specific product or company. A good independent agent can shop multiple companies and find coverage that fits your specific situation and needs. But here's the key: be upfront about your situation. Don't try to hide your bankruptcy or credit issues. A good agent will know which companies are more forgiving of past financial problems and can steer you towards better options at the right times. The agent who helped me during my rebuilding specialized in non standard insurance, people with credit issues, previous claims, or other complications. His rates weren't always the lowest, but he found coverage when most companies were rejecting my applications. And a final tip: timing matters for credit sensitive insurance decisions. If you're rebuilding credit, try to time insurance shopping for when your credit score is at its best. For me, this meant shopping for insurance about 3 months after paying down credit card balances when my utilization was the lowest. Let's talk about building your insurance foundation. And let me walk you through exactly how I rebuilt my insurance coverage after bankruptcy, step by step. And this wasn't theory, this was survival for me. Phase one was the emergency stabilization, the first 30 days. When I was rebuilding, I had to make some uncomfortable compromises. I carried state minimum auto insurance and basic health coverage through a high deductible plan. It wasn't ideal, but it prevented at least catastrophic loss while I stabilized my income. The key was having a plan to improve coverage as soon as possible. I literally had dates on my calendar for when I would shop for better coverages based on my projected income recovery. Phase two was foundation building, months 2 to 6. As my consulting income stabilized, I systematically upgraded coverage. My first priority was increasing liability limits on my auto insurance. This was a cheap protection against lawsuits that could wipe out any asset I was rebuilding. Next, I added comprehensive and collision back to my auto coverage. Not soon enough, as you heard, but with higher deductibles. I also upgraded to a better health insurance plan with a lower deductible once I had built enough emergency savings to handle the higher premiums. And the next phase was developing a comprehensive protection strategy from months 6 to 18. This is when I added additional disability insurance, increasing my life insurance coverage, and really optimizing my property insurance. I started thinking about umbrella liability coverage as my net worth started to climb back, at least into the positive territory. Then here's the documentation system that saved me lots of money, thousands. And here's something somebody doesn't tell you: keeping good insurance records can save you serious money. I created a simple system that tracked policy numbers and contact information, coverage limits and deductibles, premium amounts and payment dates, claims history with outcomes, as well as the annual reshopping results and decisions. This documentation helped me in several ways. When I had a minor fender bender, having all my information organized made the claims process faster. When I was shopping for new coverage, I could provide accurate information to get proper quotes. And when my insurance company tried to raise my rates significantly, I had documentation showing my clean claims history, at least for my homeowners, to negotiate. Next is your claim strategy. Here's something I learned the hard way: how you handle claims affects your future insurability and rates. During rebuilding, I adopted a strategic claim management strategy where for small claims under 1,000, I generally paid it out of pocket rather than filing a claim. Yes, this hurts in short term. It's not using your insurance for what you pay for, but it kept my claims history clean for a small claim like that, which helped my rates and renewability. For larger claims, I was very careful about documentation, photos, receipts, following up in writing. One major claim I did file during rebuilding was handled smoothly because everything was documented. And finally, an annual review process. Every year, I conduct an insurance audit of all my coverage. I review all my coverage to make sure it still fits my situation. As my income increased, I acquired more assets and I needed more protection. As my emergency fund grew, I could afford higher deductibles. This annual review has saved me thousands of dollars over the years by ensuring that I'm not overinsured or even underinsured. It also helps me catch changes in my situation that require coverage adjustments. Here's the key insight: insurance isn't a set it and forget it decision, especially during financial rebuilding. Your needs change as your situation improves, and your coverage should evolve with you. So let's talk about a practical takeaway from this episode, and let's make it actionable. I know insurance can feel overwhelming, especially when money is tight, but I've created a tool that makes this much simpler. The tool that I actually introduced in the last episode applies here. It's the Insurance Coverage Analyzer. It's the same system that I use to rebuild, monitor, and manage my coverage strategically. You can find this on realmoneypathway.com and the realmoneyguide.com. So here's your insurance action plan for this week. First, create an inventory of your current coverage. List every insurance policy you have, what type of coverage, current limits, deductibles, your monthly and annual premium, and when they renew. Step two, apply the insurance coverage analyzer. Categorize and review each coverage area. Step three, identify your biggest gap. Look at tier one coverage first. Are you adequately protected against catastrophic losses? If not, make that your immediate priority. Step 4, calculate your deductible reality. For each policy, ask yourself, if I had to pay this deductible today, could I do it without going into debt? If the answer is no, you need to either lower the deductible or add to your emergency fund to cover it. So, your assignment this week is pick one insurance improvement that you can make in the next 30 days. Maybe it's shopping for a better rate or better coverage. Maybe it's increasing your liability limits. Maybe it's finally getting that disability insurance quote. The key is taking action, not trying to fix everything at once, but insurance protection builds over time, just like financial recovery builds over time. Insurance isn't about paranoia, it's about intelligent protection that allows you to build wealth confidently. Today, we covered the essentials of rebuilding insurance coverage during financial recovery, how to prioritize coverage when money is tight, smart shopping strategies that save money without sacrificing protection, and a systematic approach to building coverage over time. The key insight is that insurance during rebuilding isn't about perfect coverage. It's about intelligent coverage that protects against catastrophic loss while fitting your current budget. In our next episode, Digital Financial Security for Everyone, we're moving into the modern world of financial protection. I'll share my experience with an attempted account breach that could have derailed my recovery, and why digital security has become just as important as traditional insurance. We'll cover the essential security practices that everyone needs, regardless of technical knowledge, how to protect your financial accounts, as well as your transactions, from increasingly sophisticated threats, and simple daily habits that create strong digital protection without becoming overwhelming. As you work through your insurance priorities this week, remember that every improvement you make strengthens your overall financial protection. You're not just buying insurance, you're buying a peace of mind and the confidence to build wealth. Until next time, I'm David Kim. Remember, it's not just about money, it's about building your real money pathway to freedom. Thanks for joining me on the Real Money Pathway podcast. I'm David Kim, reminding you that financial success isn't about perfection, it's about progress. So subscribe now for more strategies, and remember, your journey to lasting wealth starts with the very next decision you make.